Market structure is the base of every single trading system or strategy out there. Without objective rules for highs and lows, bearish or bullish structure, you're basically flying blind. So in this video, I'm going to give you some objective rules to follow or things or ways of looking at the market in order to identify your market structure to hopefully frame better trading ideas. Right off the bat, let's identify some rules for a swing. Don't overcomplicate it. It's nothing crazy, but in order to have an objective high and an objective low or an objective structure, whether it be bullish or bearish, you need to have these rules in place and understand them. So that way you can go forth and make better trading decisions or more well-informed trading decisions. And really just leads you into some better consistency. Okay, so to identify the high and the low in an uptrend. So I've got it listed out here, 1, 2, 3, 4, and I also have it listed out 1, 2, 3, 4 over here, as you can see. So number one, high is broken. So we had a starting point down here. That high was broken. And then there was a 2-bar pullback. And you're going to notice that the 1 bar comes down, it pulls back. And then a second bar comes down in the pullback. And that second bar down went lower than this first bar here. All right, so that considers or is considered to be the second bar in the pullback. And that is now going to tell me, okay, we've broken a high, we've made a run. And on that second bar back down, once it closes, I can draw this line going across here. I've just confirmed a swing high. Number 2, draw the high. All right, so first step, 2-bar pullback. Step 2, draw the high. Once this high is broken with a solid candle closing above that line, I can draw my higher low. Remember, this is for an uptrend. So how do I know which little low to use? Take this high, draw a U back down to the lowest point that they pulled back to, which in this case was this wick here, and then connect it with where that line was broken. So it would look something like this, draw it down, and then back up. So that is now my swing low. Confirmed. Now, over here, notice these 2 bars, they pull back, but neither of those bars goes lower than this bar here. So this is insignificant. This is an insignificant pullback. I'm going to ignore it until I have a more significant pullback, which does end up happening up here. We continue to make a run. They break, continue to go higher. Okay, this is all considered one leg of the move. And then now they've broken back down, bar 1 down, bar 2 down, and I can draw the swing high again, and the process will repeat. Now, I don't know where my new swing low is going to be unless this line gets broken, so we might just be consolidating between 0.3 and this last high that was just drawn. So this would be my swing low, this would be my swing high, and everything in the middle would just be consolidation. The good thing is, in a downtrend, the rules remain exactly the same, just flipped over. So it might be a little confusing at first, but once you kind of get it down, it's exactly the same, just in reverse. So we had a starting point, a high and a low. This low was broken. So we need to wait for a pullback. That's the next step. So we have this 1 bar here. We got 1 bar back up, 2 bars back up, 3 bars back up, but they broke out of this bar. So now everything's good. So we can draw our swing low. All right, number 2. Now, once that low is broken, we go to 0.3. That low is broken with a solid candle closing below. I draw my new swing high. Again, draw the U from point A around down to point B. Highest place that they pulled back was up here, so I draw that line. Again, continues to come down. Notice how we go into a 1-bar range. These 2 bars back up don't count because we're still all on the inside of this 1 bar. So this is one leg of the move down that just continues to go lower and lower, and that continues to happen for quite some time until you get off the screen and you can't see anymore. So that's the importance of these 1-bar pullbacks, which we're about to look at a bit more. All right, so some terminology: BIS, BOS, breaks in structure, breaks of structure. There's lots of debates about what things are called. It really does not matter, okay? For the sake of consistency, if you're watching my stuff consistently or in the future, breaks in structure and breaks of structure, let's describe those right now. So a break in structure is essentially going to be the potential of a trend change. If we've been going down, so making lower lows and lower highs, and then the market makes a higher high, that is structure that is outside of the current market structure. That is a break in structure. This can signify that the market is going to go into consolidation for maybe an extended period of time, or it could be a short period of time, or just in general that the market is flipping around. We were making lower lows and lower highs, and then we get a higher high break in structure. And then once that trend continues, we get our pullback and our new swing high, and then they continue to go higher. Break in structure, higher high confirmed, higher high is broken, break of structure, basically a continuation of the trend. So BOS, trend continuation, BIS, trend could be changing, or at least the market could be going into consolidation. This is just another example of break of structure. On the last slide, seeing the breaks in structure, basically the trend reversing and going into consolidation. But this is a good example of a trending market, obviously a little bit cherry picked, and that's okay. Sometimes it'll be this perfect, sometimes it won't. Of making higher highs and higher lows perfectly. Every time we break and go higher, it pulls back and breaks and continues to go higher. So trending market, break of structure, pullback, higher high, higher low, higher high, higher low, break of structure, continuing to trend in one direction. So why does it matter? Well, number one, we want to be aware of structure. And also, because for me particularly, or in particular, I use a certain style of trading. Some of you might trade differently. Some of you might trade the same. But structure is also a part of my characteristics and things that I look for trade entries on certain types of setups like first red and first green day, 3 days of breakouts. For example, if we have 3 days of breakouts going in one direction, usually this is a reversal setup. So we're making higher highs and higher lows. I need to be able to say objectively, hey, they've made this lower low and they're now going to pull back, and they should pull back so that I can look for my entry. Okay, so structure is a part of my entry criteria and a part of what I am looking at, whether or not the setup is actually building. So it's a very important piece of the puzzle, of course. Now, a big thing to understand as well is that once structure is broken, most of the time, of course, there's lots of different ways that the market is going to pull back. It could be a shallow pullback. It could be a bit more of a deep pullback. But every single time that structure is broken, there's going to be some kind of 3-push pullback. And there's different types of 3-push patterns that you can look for. There's like stair stepping, push, pause, push, pause, 2, 3. So it'd be like a 1, pause, 2, 3, or a 1, 2, pause, 3. However the market decides to pull back, there's going to be some sort of recognizable 3-push pattern. Now, the big thing is 3 pushes is not objective, okay? I want to make that very, very clear. 3 pushes is not objective. It is a tool to be used, a tool to be studied, and a tool to be perfected, but it is not objective, okay? The big thing for me is understanding the different types of 3-push patterns to look for. And then once I get my engulfing bar going back up or going down, I can then go and say, okay, this is the type of 3-push pattern that I'm currently in. And I can frame my setup or frame my trade based off of that information. Okay, so 3 pushes is subjective and meant to be a tool. 3 pushes helps us to find the end of a pullback. 3 pushes can also help us to find the end of a move. For example, coming out of consolidations and 3 drives, overextended markets. That is a very helpful tool and a very helpful market behavior to be aware of. I told you that we were going to talk a little bit more about 1-bar trading ranges. So let's do that now. All right, a 1-bar trading range, you're going to see them all over the place. And hopefully after seeing this video, you start to see them a lot more, because it is a way of the market shifting away from a certain area, going back into consolidation, forcing people to start speculating about direction, and then making decisions inside of this consolidation. And then now they're caught on both sides of the market. And then eventually the market will shift away from that zone, whichever direction. Okay. So for example, just looking at this one picture, you can see that a 1-bar range will show up on any time frame. You can have these ranges on a 1-minute chart, 5-minute, 15, 1 hour, 4 hour, daily, weekly, monthly. It does not matter. It just matters what time frame that you're actually trading on. So for example, I trade mainly on the 5 and the 15-minute chart. I use the 5-minute and the 1-minute for entries. Sometimes you'll be in a 1-bar range on a 15-minute chart, but you're looking at the 1 and the 5, you get sucked in and you don't realize that. It's very important to be aware of these ranges, okay? So just something to be aware of and to be looking after. So number one, these 1-bar ranges are obviously used to help us identify objectively structure, but also they're to help us identify consolidations as well. So higher high, we made this higher high. And this would have been a 1 bar range if we stayed on the inside of this low and this high of that 1 bar. But immediately we didn't. Okay, so we got this breakout, 1, 2, 3, and then an engulfing bar back down. Bar 1 down, bar 2 down. Remember the steps, draw the high, it's now confirmed. And now I have my low down here, okay? Now, as this continues to move down lower, notice how once we get back down to the low, we break a swing low, it breaks out, and then it goes into that 1 bar range sort of scenario. For, I don't remember this is a 5 or 15, so let's just say it's a 5-minute chart, 5, 10, 15, 20 minutes on the inside of this 1 bar. We get a breakout. Market only does 3 things: breakout, trend, reverse, or stay in a trading range. So we broke out, and then immediately after a breakout, we go back into consolidation. All right, this bar's high, this bar's low, and then you stay inside of this range now for 5, 10, 15, 20, 25, 30, about an hour. Almost an hour of just sitting on the inside of this 1 bar. Something to really pay attention to. We've come up once, we've come up twice. Maybe this was a 3 push pattern, maybe a pullback. Part of the pullback, something to be aware of. Let's talk a little bit about the different types of 3 push patterns, the 3 push variations. Again, if I could scream this any louder into the mic, maybe I'll turn up the volume on this thing or whatever and scream it. Not really. This is meant to be a tool. It is not meant to be some crazy, objective, holy grail sort of thing. It is meant to be a tool and a way of viewing price action in order to make better trading decisions. So these are some of the different patterns that I've observed and I have categorized or whatever. 1, pause, 2, 3, engulfment. 1, 2, pause, 3, engulfment. So kind of a caveat off of that one. 1, pause, 2, pause, 3, engulfment. 1, 2, 3, engulfment. Stair stepping. It's going to look like stairs, okay? 3 peaks, triple tops, triple bottoms. Impulse candles, large candles, relative to the previous candles on the chart. I've got an example of that, I think, in the next slide. And then any variations of these can be observed coming out of consolidation. All right, so any one of these, if you see a consolidation and the market starts moving outside of that box, you might notice one of these patterns as they are moving higher or lower. All right, any of these variations can be observed after a structural break, aka you're looking for a pullback. If you're in a pullback, you might see a 3 push pattern that looks similar to one of these. On the way back to a level, so let's say we have like previous day's high or previous day's low, or maybe even closing price from the previous day, and you're observing how price is getting to a level, or maybe even the high of the current day or the low of the current day. How does price get to that level? Could be one of these 3 push patterns, and then it could reverse off of the end of that push 3 at a level. So maybe we're already at the high of the day, we're at the low of the day, and they're working the high of the day, or they're working the low of the day. And that could be, hey, they've worked it in 3 pushes and then reverse. And then I was already looking for that setup on the day, and that could be a reason why I take that trade. And then, like I said, coming out of consolidation, if you have previous day's high or low, you could have on the day, let's say that you just have a large rectangle consolidation, maybe like Asia or London, and then they come out of the high of the day, London, and then they come out in one of these 3 push patterns, something along those lines. Could be a reason for that 3 push pattern to fail, or maybe it goes up in 3 pushes, breaks down, and then pulls back in a 3 push variation. You're going to see this stuff all over the place once you know what to look for. And this is a good place to start. So here we go. Stair stepping. Look at the size of the bars. Now, I'm not saying go to the chart and every little bar matters and all this stuff. No, what I'm saying is the candles are sized just like any other chart, but then all of a sudden the size, it looks like volume comes into the chart and it changes. Now, I don't know that this is going to be the first push. I don't know what's going to happen over here. But once we get down here and things start to take shape, for example, leg 1 down, stair step, leg 2 down, stair step, leg 3 down, 1 bar, 2 bar, 3 bar, and an engulfment. Okay, now I can say, hey, that looks like 3 stairs ending in a 1, 2, 3 and an engulfment. Maybe now I can frame my trade if I already had a larger trading idea based off of this. Hey, the pullback may be about to end. Timing on all those things, maybe I should be looking to enter. Stair stepping. 3 impulses. Okay, this was a box. This was all candles down here. This was a consolidation and a high and a low. But it's irrelevant. Look how they've come out of the box, though. Breakout, push 1, and then a pause bar. And then they continue to go higher and then go vertical, push 2. So we have breakout, pause, vertical, push 2, pause, vertical, 1, 2, 3 to the high, consolidation, 1 bar range, and it breaks back down. All right, so 3 impulses. Impulse 1 and a pause. Notice how small the candles get, and then another impulse, and then small, and then another impulse ending in 1, 2, 3. Consolidation, reversal. Types of patterns that we are looking for, very important. In summary, or in conclusion, market structure, objective rules for the high and the low. Having a good entry criteria to help you enter based off of structure. I just showed you. Go back, rewind to the beginning. If part of your entry criteria is to find higher highs and higher lows, then you know now how to look for those 3 push patterns to gauge the pullbacks, to gauge how things are coming to consolidation, to identify objectively your high and low regardless of time frame. If you're on the 1-minute chart, if you're on a 5-minute chart, 15, it does not matter. You can use those objective rules for structure. Hope you all have enjoyed. Hopefully this is useful to you. Let me know down in the comments if it is or if it isn't. And then I will see you in the next one. Bye-bye.